Let's bring in generational founder and CEO Fred Lane. Lane generational founder. Good morning, Fred, to you. And also joining the conversation all morning long, Spotlight Asset Group CIO Shana Sissel, and Forbes Media Chairman and former presidential candidate Steve Forbes. It's great to have all of you this morning. And I want to start especially with you, Fred, because as we look at the sell-off this morning, there's just so many things I think that are affecting the market. But I think it's the bigger picture. Maria's been talking about this the second half of the year. We're worried about growth starting to slow down in the second half of the year. What do you point to today's sell-off?
Well, I think there are basically three different factors kind of at work here, right? So we have had strong GDP growth. We know that. During the second quarter, the majority of companies, by a substantial margin, announcing earnings were beating estimates. So there's a lot of positives there on the one hand. On the other hand, we have stimulus, additional stimulus, which I think it runs the risk of fueling inflation. So with the fueling of inflation, the Fed is even more on a tightrope as to when to tighten and when not to tighten. They've been very clear to date that they do not intend to tighten. They intend, in my view, to let inflation run hot, which in a sense makes sense for any government function like the Fed, because we have so much government debt to deal with, and one of the best ways to deal with that and keep interest rates low is through inflation. We can inflate our way out of that problem. I think there's that issue. Then you have inflation as a backdrop. Can corporations pass on these price increases they're dealing with? Energy is obviously the tip of the spear in terms of that. And then lastly, you have this whole issue of globalization versus isolationism. And the backdrop for that, in addition to the China trade tensions, we also have the COVID issue, right? So we have, on the one hand, the word is that we're vaccinating well, and then you look at the UK basically dropping quarantining on the one hand, and Boris Johnson goes back into quarantine. So, I mean, which is it? So I think there's a lot of confusion in this market.
Yeah, no, I mean, that's what I was mentioning. I think that's a big piece of what we're seeing in the sell-off this morning, to your point, is the variant, the Delta variant. And while maybe things are looking pretty good in the United States with regards to vaccinations and the reopening and even some of the earnings we've gotten, at the same time, the rest of the world does not look so good. I want to bring in Shana Sissel into this conversation, Shana, because, there's this huge dichotomy, I think, with the markets right now where, we had a blockbuster first half of 2021, but there's a lot of talk now that the economy peaked in the spring.
Yeah, and the inflation is clearly a big concern. The market's always a little bit ahead of, earnings of the economy. And so we saw the market sort of peak out in the spring. I'd be curious from Fred's standpoint, where he's seeing the strongest earnings and what his thoughts are for earnings going into this quarter. We've only had 8% report so far. So, Fred, what are your thoughts on where we're going to see some of the stronger earnings this quarter?
Well, I don't think GDP has topped out. I think as we go back to normal activities, you can think of so many different spaces that are going to do better. I think it's going to be a great opportunity for Main Street to catch up to Wall Street. So we're going to have travel, we're going to have restaurants, we're going to have entertainment, we're going to have sports, we're going to have all of these things, I think, fueling the economy. The consumer is still very flush. Interest rates are very low. Yes, we've had a pause in the housing market. I think it's important to recognize that if you look at the last 2 years of returns in the face of COVID, okay, we've had 2 years already. The last 18 months have produced more than the average of 2 years of returns by quite a margin. That's the first thing I'd say. And the second thing I'd say is that in general, the consumer is very flush, very strong, and out there to spend money. And I think you're going to see that fueling additional inflation, because I think the consumer at the margin is going to say, I can't wait forever for these prices to retreat, so they're going to end up, I think, driving up inflation. But I think earnings are going to be good for the foreseeable future. I think it's going to be broad. We're growth investors, so we tend to focus on growth. We also tend to look at the bond market fairly carefully, and the bond market is basically saying, watch out. That's what they're basically saying, right? And so we pay attention to that. We like the companies we own a lot. we don't like the prices where those companies are trading. We don't like those at all. We think valuations are stretched, and we think there's probably greater opportunity in the mid-market and the smaller caps, but particularly the mid-market. We think there are values there.
I thought it was interesting what you're talking about with regards to the consumer and inflation, because even though we are seeing big red-hot signs of inflation, and you can debate whether or not that's a market, negative. I know it's more on your mind than it's been on some of our other guests on the show, Fred. But at the same time, if you look at what Americans spent money on in the month of June, it was clothing, it was dining out, it was entertainment, it was electronics. With this global chip shortage, you've got prices going up in addition to the COVID pandemic effect on the supply chain, which is kind of pretty stalled out right now. Real quick on oil, I do want to ask you about this. This is big news yesterday. OPEC Plus agreeing to boost output over the next 2 years. They say that global demand is expected to rise. I think you would agree with that. But look at oil right now, down almost 3%. This is inflation easing, at least for the energy market.
Well, I wouldn't put too much emphasis on a 3% drop in oil prices. Oil has been very, very strong. I think the real issue to me, if you look at oil long term, I've always been I hate fossil fuels because the culture and the society is against them. It's getting to the point where my contrarian hackles are up. Apparently, the Dallas Fed did a survey. And they found that 1% of institutional investors were willing to invest in new oil and gas exploration projects or funding for oil and gas development. That struck me as totally absurd. When you really because at some price, right? You've got to, if you're an investor, you should be willing to look at the return profile and the risk profile. And I think the risk in fossil fuels has been way overblown. And so I think, basically we're starting to look at the oil and gas space and say, gee, are there opportunities here?
Sure.
And we think there could be.
Yeah.
And yet, but the society, let's face it, if 1% of institutional investors say to the Dallas Fed that they're willing to invest in projects, that means 99% are saying, no, we have no interest. We have no interest. That strikes me as pretty unusual. And the contrarian would say, could be great opportunity there.
Yeah, no shale production in this country. Let's have that discussion again, because it was strong before the Biden administration. Fred Lane, thank you very much for being here.
Thank you. My pleasure.
All right.
Thank you very much.
Well, we are just getting started.